Cam, Bar for Cam's Mortgage Minute. Hey, there's been a lot of talk lately about IRD. It's not some fancy drug, it's not some fancy food. It simply stands for Interest Rate Differential. Basically, this kicks in when you're paying out a mortgage prematurely. A lot of closed mortgages will have either a terminology in them that will say you're either going to pay 3 months interest or IRD, whichever is greater. Now, IRD simply works in this fashion. Let's assume that 3 years ago you took out a mortgage at 5%. Now you're looking around and rates are 3%. You're like, hey, I want one of those low rate mortgages. Who could blame you? But the bottom line is when you pay out this mortgage early, the financial institution you're with says, okay, well, we're going to lose this money because when we re-lend it out, we're only getting 3% and you're still committed to us for 2 more years at 5%. So guess what? You're going to make up that difference to us. Now, some of us might say that's pretty unfair. However, you have to realize that the banking system, especially the mortgage industry, a lot of mortgages are sold off to investors and different people who are now counting on these yields throughout the term of the mortgage. You've also got shareholders for a lot of financial institutions who are also looking for returns that this institution's to generate. And the other thing you have to look at is, let's say for example, rates when you took out a mortgage at 3%, now rates went up to 5%. You would not exactly be thrilled if your financial institution called you and said, hey, you got to pay this out and we're going to start charging you the higher rate because, well, we're just going to make you pay it out and too bad for you. So the bottom line is that you just have to be careful when you're choosing your mortgage. A penalty or an IRD may not be much of a concern if you're going to live in a house for a long period of time. However, as we all know, things can change and life can cause lots of changes for us. So if you're really concerned about it, you're not sure how long you're going to keep the house, go for a shorter term. Or on the flip side, you can look at a variable rate mortgage. Most variable rate mortgages will come with usually just 3 months interest only. And they're pretty good that way. There might be the odd one that's a super low rate that might have something else, but that's up to you to double check. The other thing that you can also get is a home equity line of credit. All home equity lines of credit don't have any penalty for early payout. So again, this may not be a fit for all situations because there's restrictions on those too. But the key with all of this is to make sure that whatever mortgage you choose is the right one for you, not only today, but into the future. And that's exactly what we do here at Auxilium. We help you with that. And Auxilium simply means to care, aid, assist, and support. And we look forward to doing that for you day in and day out. And if you need anything mortgage-wise, give us a shout.